Hi everyone. After sharing 10 standalone SPY strategies over the past few months, we're finally here. In this video, I'm excited to share with you version 1 of the SPY Holy Grail strategy, which has turned $100,000 into $9.1 million over the last 21 years and has an annual rate of return of 24% versus the SPY's 10%. To recap, our goal is to beat the S&P 500's long-term return by more than 2 times with less than half the maximum drawdown. Let's dive in. You can download the detailed strategy document for the SPY Holy Grail strategy for free, and the link is in the description below. First, let's take a quick look at the SPY's performance. It has returned 10.4% per year over the last 21 years, which by itself is a very good return. This table shows the SPY's yearly and monthly returns. We can see it has generally had positive returns over the last 21 years, except for several large drawdowns in 2008 and 2022. The SPY has a maximum drawdown of 55.2% in 2008, which is the maximum loss from peak to trough before a new peak is achieved. While the 10.4% return of the last 21 years sounds like a great return, you had to sit through a very painful drawdown of more than half of your capital in order to achieve that return, which is very challenging. The average investor would have sold out at a loss and not invested on the way up due to the uncertainty and fear he experienced. When thinking about combining strategies, there are a few considerations we have to think about. Firstly, which strategies do we use to form this combination? Second, what weights do we use for each of these individual strategies in the combo strategy? And thirdly, how much leverage should we take? What we need to consider for the combo strategy is our choice between how much maximum exposure we have to achieve a certain level of average exposure. Because unlike buy and hold, where you are 100% exposed at all times, for systematic strategies, which are often trading in and out of the market and have a less than 100% exposure, we need to take into consideration how much of our capital we want to put to work and how much leverage we're willing to take to get there. To answer the first question about which strategies to use, I have picked these 5 strategies out of the 10 that I have previously shared with you to use for our combo strategy. Feel free to use any combination of these strategies to put your own combo strategy together. But I've picked these after some light optimization. You can see that by themselves, these strategies do not beat the SPY, but they typically have much lower maximum drawdowns. In terms of the weights to use for each strategy when we combine them, I have run a simple optimization and found the following combination of weights. You can choose your own combination of weights to get different risk reward combinations depending on your own risk appetite. You can see that the weights do not add up to 100%. And the idea is that these strategies are typically taking positions at different times. And we want to use as much of the available capital at that point of time as we can. Finally, we answer the question of how much leverage to use. In this table, you can see the effect of different levels of maximum exposure. If we choose 100% exposure, which is no leverage, we can get an annual rate of return of 13.8% with a maximum drawdown of minus 15.3%. Do note that your average exposure would only be 63%. So, in effect, you would be underexposed versus the buy and hold strategy. This, however, is an option for people who are risk averse or who are unable to use leverage in their portfolio. You can see that as we increase the maximum exposure limit, the rate of return goes up and the maximum drawdown also increases, but at a slightly increasing rate. Hence, we get a higher MAR ratio, which is your maximum drawdown divided by your rate of return with the use of some leverage. Based on this table, the optimal level of leverage is probably somewhere between 150 to 200%. For our Holy Grail combo strategy, I'll be using a maximum exposure of 200% to achieve an average exposure of close to 100%. This will give us a rate of return of 24% annually, which also meets our goal of finding a strategy with at least two times the return of the S&P 500 and a maximum drawdown of minus 23.4%, which is still within our goal of finding a strategy with less than half the maximum drawdown of the S&P 500. You can see that we have a MAR ratio of 1.02 for this strategy, which is very healthy. Finally, just to reiterate, all our strategies have transaction cost assumptions built in, where we've assumed a commission of the higher of $1 or 0.5 cents per share, which is the default Interactive Brokers commission, and a slippage of one tick for stop orders. Do note that we have not accounted for the net cost of leverage, which is the cost of the total leverage we have used minus the interest that we earn on cash balances during periods when our exposure is less than 100%. There's a key question to have. Won't publicly sharing this strategy destroy its edge? And good question, because alpha in any trading strategy is limited. It is akin to a gold mine where the more aggressively you mine it, the faster you will run out of gold. There are two reasons why I'm comfortable sharing this strategy publicly and why I think that the edge or alpha will not erode as quickly. The first reason is liquidity. The SPY trades over $30 billion daily. Unless this strategy attracts billions of dollars of capital trading it, our combined impact is likely to be negligible. The second reason is variations. You can choose any combination of these 10 strategies with any combination of weights that you want to create thousands of variations that will be slightly different from each other. With less overlap, the strategies will take positions at different times and there should be less alpha decay. Now for the exciting part, let's look at the backtest results of this strategy. We tested this strategy over about 21 years of data from January 2004 to January 2025. We get a total return of 91.4x, almost 100 times return, which equates to an annualized rate of return of about 24%. We have a rate of return over the last 5 years of 36.5%, a Sharpe ratio of 1.29, a maximum drawdown of 23.4%, which gives us a MAR ratio of 1.02, an average exposure of 105.8%, which is very close to the buy and hold exposure of 100%, an exposure adjusted return of 22.7%. We've taken about 933 trades over this 21 years, which is about 44 trades per year or about 4 trades a month on average. We have a trade expectancy, which is the average return per trade of 0.79%, a profit factor of 3.14, a win rate of 69.5%, an average win of 1.9% versus an average loss of 1.7%, and an average win length of 10 days versus an average loss length of 7 days. Note that these are all average figures, and with 5 different strategies with different styles, you could see trade statistics that vary significantly from these. Now let's look at the equity curve of our Holy Grail strategy versus the SPY. It is an absolutely huge difference. If you had invested $100,000 at the beginning of 2004 and bought and held the SPY, you would have $700,000 at the beginning of 2025, which, don't get me wrong, is a very healthy return. But if we had invested $100,000 into our Holy Grail strategy, we would have ended up with $9.1 million at the end of this period, which is about 13 times the amount of money we would have had if we had bought and held the SPY. This table shows the yearly and monthly returns of the Holy Grail strategy. We can see that it has delivered positive returns in every year except for 2015, where it was down by a moderate 5.3%. This table shows the yearly and monthly returns of our Holy Grail strategy versus the SPY. We can see that it beats the SPY in most of the 21 completed years, except in 2015 and 2019. In terms of maximum drawdowns, the Holy Grail strategy experienced a maximum drawdown of 23.4% during the global financial crisis in 2008. Since then, the drawdowns have been relatively modest, with the larger ones at about 15%. Compared to the SPY, this is one of the biggest reasons of trading a systematic strategy like our Holy Grail strategy. It is that we reduce the maximum drawdown significantly and make it much more likely that we're able to stay invested in the markets through the difficult periods. We can see this more clearly when we look at drawdown bars. If we had held the SPY through the global financial crisis, we would have needed to wait almost 5 years before we would have recovered. Whereas for the Holy Grail strategy, we have not needed to wait for more than a year before our equity capital reached a new high. This chart shows the 5-year rolling returns of our Holy Grail strategy versus the SPY. The Holy Grail strategy is the blue line, while the SPY's 5-year rolling return is the red line. And we can see that over any 5-year period, the return of our Holy Grail strategy beats the SPY. And this is even more pronounced if we look at 10-year rolling returns of our Holy Grail strategy versus the SPY. What's next? We're moving on to forward testing. In the next video, we will look at the recent month's performance of our Holy Grail strategy versus the SPY. Do subscribe to follow along. If you found this video valuable, please do these 3 things. You can download the complete strategy guide with the link in the description below. Do subscribe and hit the notification bell so you don't miss new strategy reviews and performance updates. And like this video if you found it valuable. For those who want to go even deeper, I'm sharing more exclusive strategies through my newsletter at grailwealth.com. You can also DM me on X at grailwealth. Thanks for watching, and I'll see you in the next video. Until then, happy trading.